Hello, welcome to the Market Carver. I'm Adam Harter, Chief Investment Officer, along with Andrew Thrasher, Chartered Market Technician and Portfolio Manager. Thankful as always you give us a few minutes of your time where we're going to talk about a few things that we hit in this week's investment allocation meeting. We're going to talk about expectations versus reality in the economy. Had some good conversation on this on Monday. I want to share little pieces of that with you. Question we've been getting frequently lately is whether or not it's a good time to buy some bond ladders, lock in some of these higher yields. And then Andrew's going to dive into, since we've got a little bit of a fixed income and rate topic there, look at rate sensitive equity. So let's jump right in to expectations versus reality. And we're talking about the economy here. So we know there's always a difference between the cadence of which the stock market's going and the economy's going, and we want to be cognizant of that. Here we're specifically referring to the economy. This is startling to me. And this is showing you the difference between where the economy is now versus what the expectation was at the end of 2019. So before we ever had the COVID-19 pandemic, we had an expectation of where the economy would be 3 years out. And as you can see from the bar at the top there, the U.S., we are actually further ahead in real economic terms. So after you back out the effects of inflation, higher than where we thought we would have been after the end of 2019. So just astounding to me. That is not the case around the world, where we have consistently been stronger economically than not only the developing world, but also Europe and other advanced economies as well. So a lot of that has to do with the strength of the U.S. dollar and how much the dollar is still king. What that means in terms of us being able to manufacture and deliver what we need to in terms of short-term economic performance. But that was astounding. But what we don't see is a matching of that in expectations. Virtually nobody you will talk to believes that the economy is in good shape. We shared 2 or 3 more charts here that we don't have in this week's Market Carver, just for the sake of time. But they all show the same thing. The pace of economic growth that we've seen the past couple of years has not been matched in consumer sentiment. In fact, it's a historic divergence between those two. Don't know exactly what it has been, but it is not new. In fact, this also surprised me. That inside that survey from Michigan, University of Michigan, that we get once a month, they ask the question, how many of you believe that the economy is going in the wrong direction? And over 50% of those respondents have been saying we've been going in the wrong direction since the George W. Bush era. And we haven't looked back since. That was consistent during Obama, during Trump, and now during Biden. Consistently, we don't have expectations that meet the reality. This doesn't mean that the economy is going to stay strong forever, but it means we're not going to match that in sentiment. So turning now into bonds. A question we've been getting frequently is, should we buy bond ladders? If that's a new term for you, this is a common methodology for fixed income investors. So you don't necessarily have all of your bonds maturing at the same time. One way to guard against reinvestment risk is to buy them that mature at different periods of time. You'll buy one that matures in 5 years, 10 years, so on and so forth. So you're constantly reinvesting them. And our philosophy is to not use bond ladders. There is a time and a place for them, but we don't employ them in common practice for FEG because you can get to take advantage of varying opportunities in fixed income markets. At different times, you will find a better interest rate or a better environment for the different options you have within fixed income. You can buy Treasuries, you can buy mortgage-backed securities, or you can buy corporate bonds or junk bonds. And throughout different times, they will have various advantages. So if you buy a bond ladder, you are buying a specific bond and you are holding that to maturity. So you are, by very definition, holding on to that same asset class and not taking advantage of what's available. And that has been a very advantageous thing for us. Mortgages come to mind right now. If you go back about 12 or 18 months, they weren't very attractive. But as the Federal Reserve has been forced to sell the mortgages that they own, it's become very attractive to scoop up the pieces and actually get a really attractive yield. So not being locked in and being nimble there has been very helpful. But it's also advantageous because different maturities do well at different times. You don't have to necessarily buy a 5 or a 10-year bond. You can buy a 2-year bond. You can buy a 30-year bond. And interest rates don't always move up and down together. And you can see that here on this chart. On the bottom panel is the 2-year note. On the top panel is the 10-year note. Not the easiest thing in the world to demonstrate because we have so many wiggles here, but you can see in general terms, dating back to late summer, that 2-year Treasury note has been pretty consistent. It got up near 5% and has stayed there. Meanwhile, the worst place to be has been in that 10-year bond. That red line going up is the interest rate on a 10-year moving up, up, up. So remember, upward pressure on interest rates put downward pressure on bond prices until we saw last week, which is a mammoth rally in bonds. So another thing that we like to do inside of our fixed income portfolio is move around what looks advantageous in terms of the best interest rate at any given time. So right idea in terms of bonds in general looking more advantageous now. Bond ladders just aren't the way with which we employ them. So if you'd like to talk more about that, by all means, I could do that all day. Give me a call. We could talk more about it. But for now, we'll flip over and talk about what the rate implications are in equities.
Yeah, thank you, Adam. So, as Adam mentioned, we saw a big drop in interest rates last week, more so than we typically see when we do see any softness come into fixed income markets. And with that, we start to look for confirmation. We want to know, are there other parts of the market that are showing similar types of trend changes? And so, when we put our equity hat on, we can start looking at certain parts, certain corners of the market that are more sensitive to interest rates than maybe some others. And some examples of that are on the chart in front of you right now. So some areas that are a little bit more sensitive are value stocks, small cap stocks, and we can look at certain sectors as well, utilities, real estate, and also regional banks. And so as interest rates start to pull back, these are the sectors or corners of the market that began to rise again. And you can see on this chart, when we have the 10-year rate begin to decline, that's when these types of investments start to increase. And when the 10-year yield starts to rise, these types of areas of the market start to struggle. And so if we are starting to see interest rates begin to turn, and in 1 week is not enough to suggest a new trend, but if we do start seeing rates start to decline, we should theoretically start seeing these types of investments on the equity side start to rise in value. And that's where we can get more confidence that we're seeing a combination of both fixed income and equity markets telling us the same story by rates going in a certain direction and these interest rate equities, sensitive equities, also beginning to either rally or if rates start going higher, start to soften again. And so we want to see these work together and then also start looking for potential opportunities if we think the trend change in rates becomes durable and something longer term that we want to gain exposure to. And so we want to look at both fixed income and equity markets and see, are they telling us the same story? Are they showing us the same type of trends? And that gives us confidence when we start making adjustments and changes within our portfolio on both the fixed income and the equity side.
All right. Thank you, Andrew. And thank you to all of you for giving us your time, as always. And we'd like to give you a reminder here, give us a call if we may be of service, 800-928-4001. Otherwise, we hope you all have a great weekend.